for those of you who are back, and welcome to those of you who are with us for the first time. My name's Doug Lennick, and I am the Chief of Staff at the Mather Group, and my co-host is Adam Recker. He's actually the smart guy on the show, and so he's the guy that will bring us every month the science of money, what happens to the science of money. My job is to talk about the science of human behavior. And today's show is called Markets Move, So Do Emotions. And markets do what they do, and Ryan's and Adam's going to talk about that. And then so do emotions, and I'll talk a little bit about that. And we'll link those two things together. So we're really excited that you've joined us again. For those who are back, and welcome to those who are new, and please spread the word. We're going to do this every month, and we'll be live again next month. So with that, Adam, I'm going to ask you, what the heck is happening with inflation and interest rates and all these things that are giving people some emotional response, I might say? What's going on? What's really happening?
Yeah, so let's pull up the first slide real quick as a bit of a background, a visual. And so a couple things. And so when people think rates, it could be two things. The first one that is probably nearest and dearest to consumers is inflation. And so pulled some recent data that's included in this chart. And one thing to keep in mind, again, kind of alleviating confusion, complexity. What is inflation? And just generally speaking, it is the level or increase in the price of goods and services over a period of time. Most commonly, we're looking at or reporting on changes month over month or year over year. As it stands today, the blue line on the chart here, again, a bit misleading due to the level of prices that's reported by the government, is showing about a 2.3% increase in inflation year over year. And so initial reaction would be, well, that's a pretty low rate of inflation, or at least growth in inflation. But the thing that I think many in our industry or even in the government may overlook is that those increases add up. And so while we may feel that things are good, what others are saying is that, no, inflation has been really, really high. And I know that because I'm paying a lot more relative to, a few years ago.
Well, when you say that, Adam, one thing that you and I were talking about before, which I appreciated you reminding me of, the only thing worse than inflation is deflation.
Yeah, and we can get to that too in a second, but
okay,
yeah.
Thanks.
No,
So keep going. Thanks.
Yeah. And so for context, though, some data we looked at, again, this is really the reason why we're discussing, the effect of inflation and things we have to do to be able to keep up with and exceed it. But since 1947, inflation's up nearly 1,400%. And so that 2.3% increase right now feels small, but the long-term effect is substantial. And absent planning for inflation, being able to address it, prepare for it, can have a tremendous impact on the ability to spend for our families. And so that's one dynamic. So the inflation piece is always important, and also feeds into the effect of interest rates. And so interest rates, again, the simple explanation is, what is the compensation I can receive for lending to another party, saving, if you will, over a predetermined period of time, or what is the cost for me to borrow? And those two dynamics end up driving the economy in very substantial ways. And so from that perspective, there's short-term rates we have to look at. And the shorter term rates, as I show on this chart here, 2-year treasuries, relatively short term, around 4%, we'll call it. And the effective federal funds rate, the rates that the Federal Reserve sets and also influence other short-term rates, around 4.33%. So what is the Fed even doing here? Like, why do they set rates? Well, it's by law, they have a dual mandate. They have to, one, seek to drive maximum employment for workers in this economy. And then secondly, maintain price stability, which really means reasonable levels of inflation, not high inflation and definitely not deflation. And I think that could be, Doug, if you think it's appropriate, probably a good time to discuss why that matters so much. Um, Inflation is okay, low levels, but we know that consumers hate high levels of inflation. You just have to pay more. You can see that every time inflation rises, stress rises, people become unhappy. The
By
alternative,
the
though,
way, and when stress rises, just as a quick aside, when human stress level rise, emotional competence, one's ability to handle things emotionally falls. And
mhm,
when that happens, irrational decision making and behavior rises. We call that miserable. We actually put that in a little slide with an M on it.
yeah,
Stress, when that rises, that's what's happening. So thank you for saying that. Keep going. You're on a
yep,
roll.
yeah. So the deflation aspect again, as I'm sure many listening to this webinar are probably aware at this point, the government has high levels of debt, and that's just it could be good, could be bad, but high levels of debt that can't be serviced are unsustainable, and there may be elements of that and concerns growing about that in this current environment. And so, why that's a problem, though, so deflation, a falling level of goods and services, often driven due to lower demand or even the expectation of lower prices in the future, is problematic. The reason why it is particularly problematic is this economy is driven particularly by consumer spending. And if consumers stop spending due to a lack of confidence, or maybe because there's an expectation of lower prices, or frankly, because they don't have jobs to buy goods and services, prices fall, the economy grinds to a halt, government receipts of tax revenue fall, and our debt becomes unable to be serviced. And so,
That's an
yeah,
issue. Yeah.
clearly
Well,
a big issue. So
yeah,
choosing between the two, if we have to choose between, or we, the government, the Federal Reserve, et cetera, have to choose between inflation and deflation, we're going to choose inflation 7 days of the week, twice on
yeah.
Sunday.
Well, that makes great sense. Now, as investors, these things create emotional swings. And one of the things we talked about last month that some of you are expecting, and the rest of you will hear for the first time, we're going to share with you a little self-awareness tool that will help you between now and our show next month deal with whatever happens every day. And it's a self-awareness game. And I'm going to start with this logic chain. I will remind you of a little bit of a logic chain for those who would like to hear where this starts. It starts with this thought of effective relationships with people and money. So if you want, talk about people or talk about money, but effective relationships with people and money is a function of how we manage ourselves individually. And that's a function of our decisions. And that's a function of self awareness. So I want to share with you an exercise. And the way the brain works is practice makes permanent. And I want you to get this into a habit so that it becomes something you pay attention to. Because the human animal, which we all are, because we're the top of the food chain, we often forget we're in it, but we are in it. And the human animal is wired to survive. Our wiring, our wiring is triggered by the emotions we experience as stimulated by some outside event. So all this stuff going on is making people yo-yo emotionally. So here's the exercise. We call it the freeze game. Remember this, practice makes permanent. So here's your exercise. Several times every day, I do this throughout the day, and I'm serious, you must do it throughout the day. It's an easy exercise, and you will be shocked at how much it can help you change your behavior with your children, with your colleagues, and with your investment decisions. Just hit the pause button and ask yourself these questions. What am I thinking right now? This is a reality check. Reality is a combination of what we are thinking, emotionally, how we are feeling, and physically, what is happening with us, what we are doing. So you see, think, feel, do. And what you're wanting to become more aware of is what you, moment to moment, are thinking, feeling, and doing. And when your emotional state might be compromising your capacity to make a great decision. So you hit the pause button, you might say, God, I'm terrified. I have no idea. Whatever it is, just be aware of what it is. Write it down. What am I thinking? I'm thinking, I don't know what's going to go on. I'm thinking, I don't know what interest rates are going to do. I don't know what I should do with my money. I'm thinking maybe I should put it all in gold. I'm thinking maybe I should put it all in cash. I'm thinking maybe I should do something. What am I doing right now? My heart is racing. My blood pressure is boiling. And are my feelings, thoughts, and aligned with what I want to accomplish? Because sometimes what happens is those emotions we feel in the short term, in the moment, interrupt what we're thinking about for the long term. And it influences us to sometimes make what we call an impulsive emotional decision. And we'll speak more to that in a bit. But that's the freeze game. And Adam and all of our colleagues at the Mather Group are practicing the freeze game. We practice it every day because we're humans just like everybody else. And we ask ourselves that fourth question: could I be thinking or doing something a little bit better? Now, just so I can say this, some of you are thinking, I already am very aware of myself. Trust me, you've all been in conversations where at some point, maybe even in this broadcast, at some point it occurs to us, I'm not really listening. Or we read a book and we get to the end of a chapter and we go, what did we read? That's because self-awareness is not a habit. If you practice this game, I'm serious, by the way, about this, totally serious, it will profoundly change your life. So with that, how do you see the freeze game helping people, Adam?
In a lot of ways. So actually, an interesting that comes up next. The next slide kind of had a thought pop into my mind, and so again, like you said, freezing and taking things in, and not necessarily acting at every emotion is very important. And again, it's hard because the long term is just a string of short terms, but we have to get through them to have the benefits of the long term. And when I look at the short term, or we look at the short term, pulled this the other day, that 1 year period, those rolling returns, anything that could possibly happen over a 1 year period tends to be a very wide range of possible outcomes. And as a natural result, there's a very wide range of emotions that can be felt over that period of time. But again, keeping that freeze game in mind, you just mentioned, if we can accept the short term volatility, the ups and downs of the market, control the ups and downs of our emotions, stick to a longer term plan, we can see very clearly that over those longer term periods, the 5, the 10, and the longer you go, the better the expected outcomes are for, bonds, stocks in particular, a balanced 60-40 portfolio, or any other mix for that matter, ends up driving returns that many would be happy with. It allows them to meet their plans, the goals, the things they have for their life. But the important thing is not getting off track and derailed by the strong emotions that we feel on a day-to-day basis.
Well, I love that. And by the way, the important point that Adam just mentioned is the strong emotions. It's the strong emotions that cloud cognitive thinking. So I'm going to share with you that those three ideas of cognitive thinking and emotion and then physical experience. Think of it as a triangle. When our triangle is stimulated from the outside, it stimulates us emotionally first. And as I pointed out, we are as animals wired to survive. The survival instinct is triggered by the emotion. So when we get scared, our emotional intelligence is suggesting our literal life might be in danger. That's what our emotional intelligence is saying. Now, our cognitive intelligence knows that's not true. The market just went down. But our emotional intelligence sacrifices accuracy for speed. And when it gets activated, it clouds our cognitive capability. So think of that thought circle as the sun, think of the emotion circle as the moon. And when you get really extremely emotional, very excited, uh, what was it Alan Greenspan said? Uh, Exuberance. Yeah, he used the word exuberance. When you get exuberant, when you get excited, or when you get scared, or when you get angry, those extreme emotions, what happens is the biology, our emotional intelligence is concerned for us. And so it sends a message to the physical part and says, we might be in trouble here. That results in chemicals being secreted biologically designed to restrict cognitive thought. So what we get is a partial eclipse. And what Adam and I are sharing with you is don't make a decision in the partial eclipse. And what your advisors here at the Mather Group will help you do is be prepared for the truth. And the truth is uncertainty. We don't know what's going to happen. But what we are doing with you is preparing you for that so that no matter what happens, whenever you need money, there will be smart places to get it. And that's what comprehensive advice will help provide you. But Adam and his team are extraordinary at managing investments, but they can't make all these little decisions every day based on how they feel. And so that's what's going on here, and I wanted you to see it. So back to you, Adam. Anything you'd want to add to that?
Yeah, I think the thing that jumped out, maybe a bit timely, the eclipse comment. If we go to the next slide, because and you also alluded to this last month, Doug, the Dalbar study that had come out on the actual effect of investors, their performance versus a standalone benchmark that they should be invested in isolation. And so, looking at the S&P 500 over the past 20 years or so, the exact comments you made play out here. You know, the reason why the average equity fund investor in the S&P 500 is not receiving the S&P 500 return is not because they're sitting there and being patient and controlling emotion. It's the exact opposite. That period of stress and eclipse, as you say, not only eclipses the emotions, the decision making process, but also the returns that they receive in the end.
Oh, yeah.
So there's a penalty that's paid for not keeping your cool in the end. Doesn't mean you ignore the emotions or ignore what's going on in the market. It just means that you don't need to act on it in the moment when you're not making clear decisions. And that applies to all of us, especially
Exactly.
as professionals, because we have to deal with the same emotions as everybody else, but we have
Right.
tools and processes, systems in place to help overcome those emotions.
Yeah, well, you and exactly right. And what we want to do is equip you, our clients, and our prospective clients. We want to equip you with the tools that will help you make an emotionally competent decision in the presence of these competing and difficult to deal with emotions. So practicing the freeze game will change your life. The Delbar data basically say data comes out every year, and it says year after year, investments work better than investors. And the reason investments work better than investors is investments have literally no emotions at all. The investors do. And it's the investors who are making these decisions. And so what we're not saying is this is buy and hold. What we're saying is buy and be smart. If you need money when the markets are down and you know the comeback is coming, that's not the place to take the money from. So our advisors will, of course, be advising you to keep an amount of cash that allows for you to survive, if you will, and even thrive during those periods and take advantage of them. So this is very important. I'm glad you threw in the Delbar data. Thank you for doing that. And I know you have some other things, how this hits the actually classes of investment. So
Yep,
I'm going to go back
absolutely.
to science of money, back to Adam.
Yep. And so if we go to the next slide too, and most likely the one after it, a couple other things given the topic of the conversation, inflation, interest rates, what to do about all of it. And so again, back to the longer term before diving into maybe some additional asset classes, but obviously we want to make sure we're driving returns after inflation. And as we can see in this chart here, inflation, while it adds up in the long run, looking at just one asset class in particular, the S&P 500, again, shouldn't be the only asset class that's considered in a diversified portfolio. But there's a strong track record of putting money to productive use results in returns in real terms that exceed inflation. And so the key takeaway there is you simply cannot sit in cash and ignore it and ride out the fear. You have to do something. But it requires a well-calibrated, risk-appropriate plan to reasonably be able to exceed inflation, whether it's due to short-term market movements or longer-term trends. On the next slide, then, looking at some more specific asset classes in inflationary regime environments. And so, looking at things like real estate gold, the 10-year treasury, which we on the previous slide we kind of glossed over, but that's also driven by supply, demand, views on the economy, expectations around what does future growth look like. And so right now we actually have some competing, I think, pushes and pulls taking place. One, I think it's reasonable that many expect maybe a slower growing economy, just given where we are in the business cycle, the maturity of our economy, demographics, things like that. But on the flip side, speaking back to the debt levels that have become a growing concern for many, maybe having a weaker treasury auction where there's concerns about our ability to pay down the debt. And so other countries aren't nearly as interested in buying our debt, drives up rates at the same time. And so there's a competing tug of war in a sense around should rates be high, should they be low. Right now, though, we are in an environment where they are higher than before, above, close to 4.5% for a 10-year. You look at the 20, the 30-year above 5%, even for taking on some credit risk, seeing investment grade bonds close to 6%. Those create a bit of a decision point around should I be looking at buying more bonds that are generally low risk relative to stocks? And so that those decisions are a bit murkier and things we've got to have on a client by client basis. But again, being data driven, evidence based, looking at some of the broader asset classes, real estate, gold, short term bonds, the 3-month treasury, stocks in the US. A notable emission international actually does really well in inflationary environments. Can't overlook that. But also looking at what inflationary regime are we in. And so as of today, saying 2.3% year over year is kind of where we've been recently. Doesn't mean it's going to stay that way. But we can see throughout that environment, generally things that are, like real estate, stocks, they tend to do pretty well. And bond returns are generally tied to what is the starting rate or starting level of interest rates in the environment. Start to look forward. Well, what if inflation picks up? How do we respond to that? You can see, again, things like real estate risk assets tend to do well, but noticeably you start to see asset classes like gold and commodities do a bit better. And then especially in a very high inflationary environment, as we've alluded to in I think past conversations, stocks, again, generally tend to do well, but candidly, inflation, very high inflation environments are not very good for stocks and bonds. But that's an environment where you start to see a little bit more stability out of things like gold and commodities. And so the main takeaway, you're good, Doug.
Well, I was going to say, I think sometimes, Adam, that people get confused about a bond, and just the phrase fixed income security. What sometimes is confusing to people is what's fixed.
Yeah.
and the answer is in the statement, fixed income security. It's the income that is fixed. The underlying bond value changes based on interest rates. What I commented on relative to investors, oddly enough, happens to bond investors and stock investors. Bond investors also underperform the bond market because they're doing the same thing. They're not remembering, oh, I have an income here that's fixed. I don't have to sell this bond at a loss. But emotionally, the bond went down. I don't want it anymore. And so people sell bonds at a loss. And so what I say to people, unfortunately, a lot of people are underperforming both the bond market and the stock market. But when they're doing it in the bond market, it makes them feel better because they're underperforming safely. Like
Right.
what? But it's the idea of you don't have to underperform. That's where our wealth managers will really come in handy. And the entire team, the experts that we have here at the Mather Group, are here to help you understand. We're preparing you so that if you need money today, there will be a smart place to get it. It might not be selling stocks, it might not be selling bonds. Might even be a good idea to buy stocks or buy bonds, whatever. So
Right.
anyway, I'm just going to interrupt every now and then with those kind of little comments. I can't
No,
help myself, Adam. I'm sorry.
it's helpful. No, and I think that also is a good segue to the next piece too. It's the probabilities. And so while we see there's data that says certain things are expected to do better in different environments, and we have to take that into account when making decisions in a very unbiased, unemotional way to the best of our ability, it does not mean anything's guaranteed. And that's why having the plan ahead of time, knowing what your specific plan is so important. And so this chart here though is showing this probabilities. While we say on average the returns are good in those different environments, this kind of not picking on gold, but it's one of the key things that come up when we hear about inflation being
Oh, yeah.
higher. People think
Oh, yeah.
great hedge. Not necessarily, because it's not guaranteed, especially over short-term periods of time. If you look at the average sort of rolling 12-month period, there isn't a single asset class out there that is guaranteed to keep up with inflation, no questions asked. And so, but some have a higher probability than others. Again, like we had
And
mentioned.
I notice none of them make it to 100%. I don't see any 100% probabilities.
Right. And so that's why even when you think, oh, this thing should be a good inflation hedge, it does not mean that it is guaranteed to hedge inflation. But again, having the right mix of assets, some with greater inflation protection characteristics than others, being able to zoom out over longer term periods of time, not just that messy, volatile 1 year period, but structuring things, the plan, the portfolio in a way that you can get to those 3, 5, 10 year plus periods without unforced emotional errors. That drives then the probability higher that you are going to have in aggregate a portfolio that exceeds inflation 100% of the time. But again, the short term is not guaranteed. And so there is not a magic, solution for the pain that is being felt in that moment. So we
Well,
have
and I love that, and that's just the reality of it all. And to your point, overall, the only way to really get at being in a position where whenever I need money, there's a smart place to get it, is I need some diversification in my financial instruments, both my investment instruments, my insurance instruments, and my debt instruments. So I got to be looking at all that stuff, and I think you're helping everyone see the importance of that. So our overall message remains: your plan is doing quite well. You're doing quite well, but on the emotional, we experience humans experience life emotionally. We don't experience life thoughtfully. We think about it cognitively and thoughtfully, but we experience it emotionally. We're humans. And one of the things that the Mather Group will be is the best at dealing with humans. It's humans with humans. So, key takeaways, Adam.
I'd
What do
say
you?
the key takeaways is, like they say on the page, not to read directly off it, but like
Yeah, it's all right.
the underlying markets, inflation rates, that's all going to move, and so are the emotions. And so the more attuned we can be with those emotions, making sure that we aren't being the problem in a sense, because the markets don't have feelings. We do.
No,
So we're the ones that are responsible for controlling them, not the market. The market doesn't
right.
care one way or the other. And so, and the best way to do that, be able to sleep well at night, is making sure that before these emotions arise, we're aware that the emotions are going to arise. We have a plan that is going to work regardless of what those emotions are. And being able to default to that proven plan allows us to address the emotions, work through them, let them fade away, and know that we'll be better off for it.
I love that. Our home office is downtown Chicago, and we're right off the Chicago River. And if you fall off one of those tour boats, you will have an emotional experience, but the river currents won't. And so it'll be important to understand the emotional self-awareness part. This is really a big deal. Practice the freeze game. It'll change your life. We've got some good things coming for you coming up. Are there anything else that you want to say in closing? I think we've had a really good show and we're within our half hour, I believe. I do want to say the brains behind this, Adam and I owe a lot to Deanna Lewis. So for those
Yeah,
of you who ever get a chance to thank her, do that.
yeah.
But I have nothing else. You got anything?
Nothing that comes to mind. So
All right. I think we can wrap it right here. Thank you all for being here. We really appreciate your attendance. Please encourage your friends to join us next month. And I imagine they could probably even find this link and see this one. I don't know. Do you know that, Adam? I think so.
I
I,
think so.
we'll figure
But
that out.
Deanna will figure it out, as we always
Yeah,
do.
and we'll figure it out. Thank you all for being here. We'll see you next month.